Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Yue Yuen Industrial Holdings Limited Annual Report. Yue Yuen Industrial Holdings Limited is a diversified business entity that offers a wide range of services and products. At its core, the company is an investment holding firm that manufactures and sells athletic, athleisure, casual, and outdoor footwear globally. The company operates as an original design manufacturer/original equipment manufacturer for several international brand names, including Adidas, Asics, New Balance, Nike, and Salomon. This means it designs and produces products for these brands under their labels. In addition to manufacturing, Yue Yuen also retails sportswear, outdoor, and leisure products. Beyond its retail and manufacturing operations, the company offers a range of services through its sport service platform. These include event sponsorship, promotions, sports center operations, and design services. The platform also provides online and offline services such as events, venues, media, broadcasting, shopping, activities, registration, ticketing, and other sports-related services. Furthermore, Yue Yuen Industrial Holdings Limited offers commercial spaces to retailers and distributors, providing them with a physical presence in various locations. The company also provides corporate management consultation services, offering expertise to businesses in areas such as strategy and operations. Lastly, the company trades in footwear, both domestically and internationally. With its extensive network of suppliers and distribution channels, Yue Yuen Industrial Holdings Limited is well-positioned to meet the growing demand for athletic and outdoor footwear globally. The significant increase in Yue Yuen Industrial Holdings Limited stock price over the past year can be attributed to several key events and developments. One major catalyst was a favorable Supreme Court ruling in Indonesia, which resulted in a cash recovery of $29.3 million for one of the company's subsidiaries. This positive outcome not only reversed tax expenses, but also led to further anticipated benefits from remaining disputes. In addition to this significant event, Yue Yuen's retail subsidiary, Pu Sheng International, reported an impressive 81.5% year-on-year revenue surge in China in February 2026. This strong performance contributed to the company's overall net consolidated revenue growth of 19.4% for the month and 0.7% year-to-date. Analyst rating upgrades also played a role in boosting investor confidence. CD raised its target price for Yue Yuen Industrial Holdings Limited to HKD 21, citing improved operational efficiency and slightly better than expected performance in 2025. Furthermore, the company's commitment to maintaining high dividend payouts has likely supported investor sentiment. Lastly, strategic investments in India, such as the construction of a new manufacturing base with a phased investment of approximately $276 million, are seen as long-term growth levers for the company. These developments have collectively contributed to the stock price increase and demonstrate Yue Yuen's efforts to drive growth and stability despite challenging market conditions. Yue Yuen Industrial Holdings Limited market capitalization of $26 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Yue Yuen Industrial Holdings Limited holds a significant advantage in their industry. Yue Yuen Industrial Holdings Limited trades at a higher price-to-earnings ratio of 9 times and a lower price-to-book ratio of 0.73 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appear attractively priced. Investors should evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The company maintains a moderate leverage profile, with liabilities making up 33% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 7.94%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be categorized into several key areas. On the decline side, a decrease in trade receivables by $20,159,000 and subdued consumer confidence have contributed to a 1.8% drop in revenue from 2024 to 2025. Additionally, a significant decrease in sales at Pu Sheng, minus 57.1%, has also impacted revenue. On the growth side, various product categories have shown an increase in revenue. Athletic/outdoor shoes and casual shoes/sports sandals have seen a surge of 4.5% and 12.6%, respectively. The manufacturing business has also experienced a 0.5% increase in revenue. Geographically, the US and Europe have seen growth of 4.3% and 6.8%, respectively, while Indonesia has shown an impressive increase of plus 10.1%. Customer-specific drivers have also played a role, with customer A experiencing a decline of 6.5% in revenue. However, customer B's revenue remained relatively stable. Product-wise, soles, components, and others have seen a decrease of minus 22.1%, while athletic/outdoor shoes and casual shoes/sports sandals have shown growth. Lastly, other drivers such as employee benefit expense and research and development expenditure have increased by 1.8% and 2.4%, respectively, contributing to revenue growth. Overall, these factors have contributed to the fluctuations in revenue from 2024 to 2025. The net income of the company experienced a decline of 8.3% in 2022, resulting in a net income of $827.8 million. This decrease is evident from the financial reports on page 18. However, there is no explicit mention of any change on page 19. In terms of profit margins, the company witnessed a decline across various categories. The gross profit margin decreased by 1.6 percentage points to 22.8% on page 18. Furthermore, the manufacturing business saw its gross profit margin drop by 1.7 percentage points to 18.2%. On page 19, the gross profit margin declined by an additional 0.7 percentage points to 33.5%. The reasons behind these changes in net income and profit margins are not explicitly stated in the provided text. However, it can be inferred that the company faced challenges in maintaining its profitability during this period. The company's financial performance indicates a strong ability to generate cash from its operations. According to the provided summary, the net cash generated from operating activities, after accounting for taxes, is a significant US $591.2 million. Furthermore, this operating cash flow has resulted in a substantial free cash inflow of US $265.3 million. These figures demonstrate that the company is successfully converting its profits into liquid assets, which can be used to fund future growth initiatives or pay off debts. The company's debt level has seen a significant increase over the past year. Total bank borrowings rose from $757.3 million in 2024 to $788.7 million in 2025, indicating a substantial growth in the company's financial obligations. Additionally, other financial assets at amortized cost have increased by a staggering 429.5%, further contributing to the overall increase in debt. On the other hand, interest expenses have decreased significantly. The company's interest expenses dropped from $52.8 million in 2024 to $44.6 million in 2025, representing a notable reduction of around 15%. Furthermore, finance costs on lease liabilities also declined, falling from $9.9 million in 2024 to $8.3 million in 2025. This decrease in interest expenses suggests that the company may be benefiting from more favorable financing terms or lower borrowing rates. Management is cautiously optimistic about the company's outlook, driven by its focus on innovation, technology, and sustainable materials. This strategic approach will enable the production of high-quality footwear that meets the stringent standards of brand customers. The company is committed to digital transformation, which will drive manufacturing excellence and support its pursuit of strategic expansion and optimization of manufacturing capacity. A selective approach will be adopted for opening and upgrading experience-driven retail stores, ensuring a tailored and effective retail strategy. Additionally, the company has made significant progress in establishing a strong presence globally, including entering into a memorandum of understanding with the Tamil Nadu government in India to establish a manufacturing base. This move is expected to support sustainable growth investments, which will be explored through opportunities that align with the company's strategic objectives. There is no significant activity to report on acquisitions and divestitures. The company has not made any notable purchases or sales of assets, businesses, or subsidiaries during the period under review. This indicates a stable and conservative approach to business growth and expansion. The company has a history of paying dividends to its shareholders. This is evident from multiple sources, including pages 1, 12, 23, and 24, where it is explicitly stated that the company has paid dividends. However, there is no information available on whether the company has bought back shares. Concerns about inventory buildup or supply chain disruption exist. There are valid concerns regarding the potential for inventory buildup and supply chain disruption in various industries. The decrease in net changes in allowance for inventories on page 11 suggests that companies may be holding onto too much stock, which can lead to wasted resources and reduced competitiveness. Supply chain disruptions are also a concern due to tariffs and geopolitical uncertainties, page 14. This can cause delays and increased costs for businesses, ultimately affecting their bottom line. Elevated industry inventory levels and operational deleverage on page 15 further exacerbate these concerns as companies struggle to manage their stockpiles effectively. The explicit statement of concerns about inventory buildup on page 17 highlights the severity of the issue. Regional conflicts may disrupt shipping logistics, page 25, leading to production bottlenecks and uneven demand leveling. This can have far-reaching consequences for businesses and economies, making it essential to address these concerns proactively. That concludes the financial summary for Yue Yuen Industrial Holdings, Limited. Feel free to comment below, and I will be happy to answer them when possible.